Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. Welcome to episode 13 of Retirement Unpacked. My name's Adam Bornn. We have Brett Martinson, manager of our financial planning team, here with us as well. And we are here to answer your questions. So again, if you have more questions, make sure to write those below. Anything around finance, retirement, tax, estate, anything that comes up in your life around how do I get to and through retirement, we're here to answer those. So Brett, let's jump into number one here.
Absolutely. So first question, are financial advisors restricted on the advice they can give? So this comes from Adventures on Vancouver Island 3875. Are there certain restrictions on what you can suggest due to regulatory requirements? For example, are you allowed to suggest the Smith maneuver or leveraging investment in general, how to integrate it? And they go on with a story that I got barely 60 minutes. And I'm going to make a couple points on what I'm about to say here. I'm just going to read the comment. I got barely 6 minutes with someone who had a heavy accent and just barely moved into Canada. So I will be making a comment about that. And they try to sell you 2% mutual funds. I got the sense they had no clue and didn't want to talk about Smith maneuver and interested in selling. I closed my account a week later, looking to self-direct. So first of all, whether the person was born in Canada or not born in Canada, or where they came from, has nothing to do with this. In my opinion, it has everything to do with either who that person is, a personality, and or the training that they received from the financial institution. And having worked at larger financial institutions in the past, I've seen great training and I've seen not so good training. And I would probably easily throw this at the feet of they were probably told to get out there and sell because that's how you keep a job here and that's how you make us happy. So I wanted to point that out. You're restricted on advice to which you are licensed to talk about. So for example, I used to hold an insurance investment license so I could speak specifically to those products. I voluntarily gave up those licenses a number of years ago, so I can't tell somebody to buy this stock or bond and sell this stock or bond. I can talk in generalities about stocks and bonds. I just can't get into that. Similarly with Smith maneuver and leveraged investing, I can talk about the generalities of it as long as I have some knowledge or background about it. So what I'm getting from this is that they probably didn't know about it. And unfortunately, they probably didn't say, well, I don't know about that. And that's not my background. That's not my knowledge. And I've said that to clients before. I said, look, I know enough to tell you questions to ask somebody else, but I cannot guide you in this area. I don't know. I don't have the knowledge in that area. So to answer the question of are they allowed to what they can advise on and not advise on really comes down to A, their license, and then B, they should be upfront to say, I do not have the knowledge to talk to you about that. Those are my thoughts there, Adam. You?
When you're getting someone just at the bank level walking in at the branch, Smith maneuver might be a bit more complex. Like I don't know if I'd expect them to know that they're there to. I got $50 a month to save. What should I do with it? That's kind of more in line with what they're trained. And remember, most, not all, but most financial institutions, part of their compensation is sales, right? They get paid commission based to sell product. So of course, talking about a Smith maneuver isn't selling product. So not totally surprised there. So next question. At death, does CRA treat LIF like a RRIF? So life income fund like a retirement income fund. And this comes from Q Corner 1. Great content as always. As you are often asking for questions, I'll put one forth. You often cite content about RRIFs and the importance of melting these down for tax purposes to avoid CRA tax cruelty upon death if a successor annuitant hasn't been named. I live in Alberta, have a RRIF and a couple of LIFs. When one of us dies, the other will have these accounts. But when the second spouse dies, or if unmarried, does CRA treat the LIF accounts like they do the RRIF? The answer is yes. So, if you're not married or if you're the second of the two of you, when you pass away, that becomes taxable income in year of death, whether it's a RRIF or a LIF. They are treated the same at death. So that's a simple question there. Again, there's a couple follow-up questions there back and forth. But yeah, RRIF, LIF at death, treated the same.
Yeah, a LIF is actually a special RRIF. It's essentially a RRIF with some rules on it. And Q Corner 1 goes on to say that LIFs need to be LIRAs and LIFs need to be brought into the same light, as they can sometimes be tougher to melt down due to the withdrawal restriction. And yes, that is true. Although depending on the jurisdiction, you also have other rules to work with. You've got the usually a 50% unlocking depending on the jurisdiction. Some places now do 100% unlocking: Manitoba, Saskatchewan, and Quebec. And then what's called the small balance unlocking as well. So yes, you're right. They aren't as straightforward as RSPs and RRIFs. We have done some videos on them if you search our channel, or just YouTube on them in general. But when the second spouse dies, virtually all money is deemed disposed of at that moment of death, and therefore taxed as anything is going to be taxed based on its component: RSP, RRIF, LIF, that type of stuff. Yeah,
exactly. Yep.
Number 3 here: is it better to take RRIF as yearly lump sum or monthly? This is Bobby G 1000. You may have answered this already. Is it better to take your RRIF yearly withdrawals in a lump sum or monthly? Love the education videos and podcasts. Thanks very much, Bobby G. I would say that there's no one is better than the other. It just depends on, first and foremost, I think, your cash flow needs. If you have enough cash coming in from other sources, be it a work pension or something like that, then what I tend to tell clients, and when I used to manage investments as well, I would do the same thing, is let's leave these what I call taxable transactions towards the end of the year, later October, November. The only reason for that, two main reasons: one, your taxable income is better known. So if you have a large capital gains on something earlier in the year, then you can adjust the RSP RRIF withdrawal to kind of offset that. The other reason too is that there are withholding tax on RSPs and RRIF. So if I take the same amount of money out on January of a year, if I take the same amount of money out divided by 12 monthly over the year, or take the same amount of money out in November of a year, there's a certain amount of withholding tax. I'm just giving that withholding tax to the government for a least amount of time if I'm taking it out, say late November. So no one right or wrong way. I think it's just based on, as I tell clients, don't eat Kraft dinner for 9 months just because some crazy guy on YouTube told you to do it later in the year.
Yeah. And for most people, if your RRIF is your main income source, you probably want to set it up monthly, biweekly, however you were paid before. Like as you enter retirement, keep your payments the same. If you're paid biweekly, set up your income payments for biweekly. Just like keep stuff as simple and straightforward as possible. And that's one way to do it. So,
yep.
The next question, David Black 6413, longtime viewer, follower, supporter, all of that. There's many layers to this question, so we're going to spend some time on this. But that's really administering taxable trading accounts. And I know there's a lot of DIY investors that listen to us. So he says, life is good when Adam and Brett answer several of my questions. Perfect. The series is rapidly becoming must-see viewing for financially literate Canadians, a kind of practical answer to the more academic rational reminder. So always, appreciate the comments, and I don't know if we fall in the same bucket as Ben Felix there, but yeah, appreciate that. And glad, like we're trying to make this applicable. Like here's stuff you're running into, here's how you get through it. So my question arises from the work of being a volunteer asset manager, which many of you are, for a number of family members and friends, having set up and run DIY accounts for many of them over the years, and notably as the ETF revolution has really brought the value of DIYers. So here's another question, one inspired by my wealthiest family member and air quotes client, whose assets are mostly in non-registered accounts. where it comes to registered accounts, RSPs and TFSAs, and their equivalent, once converted to income funds in the drawdown phase, there's ample advice available, which obviously we provide a lot of that as well. As what you can do and how you do it are well traveled and documented. When it comes to non-registered trading accounts, however, the place of these within retirement finance is arguably less well understood by the average investor. So again, we're not talking RSPs, TFSA, we're talking about a non-registered account. How do you manage this in the decumulation phase? So so I'd love your thoughts on how best to think about and administer taxable trading accounts. I appreciate that if a person has filled their RSPs or RRIFs, as well as their TFSAs, sizable non-registered accounts are a nice problem to have, but they are, from a management perspective, still a problem. I totally agree with that. Like I said, I mentioned last podcast, doing a plan for a client with a $23 million RSP, but also has even more than that in a non-registered account. Like there's just taxable issues. So I'll just make a quick comment, then let you jump in here, Brett. But so how best to think about and administer taxable trading accounts. Now, you have to remember, if we take a kind of peel back a bit here, obviously for this wealthy family member that you have, David, they probably maxed RSP, maxed TFSA, now they have non-registered. That's typically how you get to non-registered account, is you've maxed out your other registered accounts, TFSA and RIF or RSP. So remember that in a non-registered account, any gains that you have there are taxable every year. So that's where you got to figure out, first, build a plan. So where is the income actually coming from? So let's say you build a plan and it's, okay, well, I need 100 grand a year and I'm going to pull 80 from the RIF and 20 from the non-registered account. Okay, well, we need 60,000, let's call it 3 years of income in the non-registered account, not tied to the stock market. The rest of it can be a bit longer term growth. So it needs to complement the plan that way. Now, obviously that 60,000 that's sitting in cash or similar type product, yes, it's producing interest income. It's not very taxable, very tax efficient the way it's structured. So you always want to look at, like, my overall risk parameter or risk tolerance that I have. Where is that money sitting, right? Ideally, you want capital gains in your non-registered account, then dividends and interest income, because that's kind of the way that they're taxed. So if I own more capital gain, i.e. stocks, in my non-registered account, I might have to balance that out with more fixed income in my registered account. But that's a good thing, because in your registered account, whether you're on a capital gain, a dividend, or interest income, it's all taxed the same when you pull it out. So this is when you start managing accounts, you want to look at, first off, like, where do I need my money from? Where is that my actual drawdown decumulation income coming from? And then, so protect that first. And then from there, you need to create tax efficiency around, like, where does it make sense to hold certain types of investments, but keep my risk tolerance the same? So Brett, I'll let you jump in there.
Sure. All good points. I'll add a few things. First of all, whenever we're mentioned in the same sentence as Ben Felix and Rational Reminder, that is, if I knew 10% of what Ben knows, I'm doing okay. A couple comments. I meant to mention this a couple podcasts ago when something came up similar, volunteer asset manager working with friends and family. I don't know the answer to this, but I would check into what your potential risk is there and liability and things like that. If something goes south, if they don't like something or whatever the case may be, I'm sure you've got the best intentions and the best relationship with them, but I would personally be looking into, and anybody else that's doing this, into what would your potential liability be if somebody just thinks that you did the wrong thing at the wrong time. In terms of the non-registered accounts, a couple things I'll add there is, one thing I think people, it's helpful to remember is that at the end of the day, it's how much tax do I pay? Yes, dividends, capital gains, all that kind of stuff. I can create the same $20,000 of tax from an RSP RIF, from a interest income account, from a capital gain sale, a dividend paying account. So I can create the same $20,000 tax efficiently, but the fact of the matter is it all boils down to how much tax am I paying year on year over the course of the plan. So as you said, there might be reasons for looking at what they call asset location, where to locate these various assets. Going back to Ben Felix, he did a research paper, I want to say 7-ish years ago about this. And if I remember the conclusions right, it only started to make sense when we started to talk about drastically large non-registered accounts, $1 million plus. I'd have to go back to the research paper, but I do remember that in general. And when you're thinking about these taxable registered accounts, or sorry, taxable non-registered accounts, they add to your tax. They add to your tax planning. They may not be taxed like an RSP. They may not be taxed like a corporation. They may not be taxed or different tax inside that non-registered account, but they add to your taxation. And when we are doing our plans and there's a relatively large non-registered account, or even not very large, but huge capital gains, that affects the meltdown. That in the end, it's what taxes are we going to trigger RSP non-registered, and how do we do it in a in the most tax efficient way possible.
Yeah. And Brent brings up a good point. Like, there's a lot of, we hear from a lot of people say, yeah, I manage money for my family, right? It's because you did well yourself, and families start leaning into it. Yeah. It's not even just a liability, but it's just that relationship. Like, what happens if that relationship, the investments go south? Does the relationship, like, is it worth it at the end of the day? And, you mentioned on our notes here for the podcast for this comment from David Black about, Rob Carrick, right? Like, Rob Carrick, Globe and Mail for 20, 30 some years, pioneer, like, just everyone knows Rob. He was DIY. He retired, or I'll say retires in air quotes, semi-retired. Yeah. But he came out recently and said, I have my money managed now. Like, the decumulation phase is just different. And I think we'll hear more from Rob over the next 6 to 12 months on this, hopefully. What led him to that decision. But the fact that he's preached DIY for decades, and as soon as he hit retirement, it's like, there's more to it, right? And it's kind of what we've been talking about for years. Like, decumulation is different. It's not the accumulation phase. And to see, someone that, was front and center on that, make that same decision, it kind of, when I saw it, I was like, well, good. That, like, it kind of confirms what I've been seeing and saying, and our team's been seeing and saying for years now. So I would say to David too here, and anyone managing money for yourself or for family, friends, whoever, as they walk into retirement, or as you walk into retirement, I would take a step back. Like, is this really something I want to keep doing? Because it does change. Like, it's easy to have a friend say, hey, I got, $1,000 a month for you to invest and buy good companies. Like, that's fun. But when they're like, hey, I need $1,000 a month, it is a different ballgame. So just, maybe take a step back and figure out, do I want to continue doing this going forward in retirement?
Yep, absolutely.
Yeah.
All right, next, hey, Rob Carrick might be a great guest to have on one of your YouTube videos. I just thought about that as we're talking about it. That process better than I do, but
I'll reach out to him, try and get him on. I know, he's close with Mr. David Chilton. Got the book in the background. We'll have
there you go.
Yeah. So we're recording this before we have him on, but he will have been on by the time this gets launched. But it's I'll reach out to him for sure.
Make that network work for you there, Adam.
Exactly. There you go.
Next question: husband and wife, various accounts, income splitting. Do you start CPP and OAS at the same time? This comes from Mike Gould, 9278. Great series, gentlemen. Could you unpack, in air quotes again, saw what you did there. Fantastic. Could you unpack a few strategies for a retiring couple where one spouse has a significant defined benefit pension while the other has RSPs and TFSA? Maybe touch on income splitting, drawing down, delaying starting the defined benefit pension plan should they take CPP and OAS at the same time. And last comment here. I know it depends, Brett, but humor me. Thank you, Mike. These are my people. This is my tribe. These are the people that thank you, Mike. So in terms of all this, there is a lot to unpack here. So the defined benefit pension plan, when you start taking that, will be able to be open for income splitting. A defined benefit pension plan can be income split at any age that you're taking it. So whether you delay starting it or not touches on some of the things we've touched on in previous podcasts, which is there a benefit to delaying it? Are you going from what's called a reduced pension if you started it today, for example, to an unreduced pension if you started it 3 years from now? And if you delay 3 years from now until you're 71, is there a noticeable difference in that? And again, the math will explain that. So in terms of it depends, but humor me. Again, I'm joking at the comment. I think it's a great comment. At the same time, it really kind of comes down to what are the considerations? The considerations are, does it provide a benefit for you to delay? And the math will play that out in terms of, am I getting any more money from this defined benefit pension plan by waiting one more year? Income splitting. So income splitting can be done from a RRIF in the RRIF and a LIF in the year in which the owner turns 65 and onwards. We cannot income split from RSP at any age, nor a RRIF or LIF before that point, and it's based on the age of the owner or annuitant of the account. Drawing down investment accounts first. A plan's really going to show exactly what to do there. Typically, you're going to be looking at your taxable accounts first and foremost, RSP, RRIF, LIF, but in what manner do you do it and how much is something that comes out in a plan. And then finally, CPP and old age security, start them together at different times. I can't think of a plan that I have done or looked at or been involved in over the last 13-ish years where there was a reason to start them at exactly the same time. They may have started them at the exact same time. Okay. It may have worked out that way, but I can't think of a plan where it says you must start them at the exact same time. And here's why. So I would say there that that's
the only
more
clients
of a,
I've
it
ever
works out that way.
remember. Yeah. The only clients I remember exact same time, they were, husband and wife, their birth dates were one day apart. So they turned 70 on the same day, basically. So it's shouldn't matter. Definitely don't have to start at the same time. And like you said, it all depends on the situation. But when I read this, I'm like, big DB plan, RSP on the other side, like income splitting, complemented over here. Like, it's a nice structure to create some really nice tax efficiency income splitting within the plan. So, next question. Moving TFSA GICs to high interest TFSA considered a withdrawal. So this comes from Andrea 11240. Is moving a TFSA GIC account, so basically a TFSA, the GIC is the investment within the TFSA, to a high interest TFSA account considered a withdrawal? And the quick answer is no. So as long as your TFSA, let's say it's at RBC as an example. So you have a TFSA at RBC, and within that you have a GIC that maybe you bought a few years ago. It was paying you 5%. It was great, but it's coming up for maturity, and to renew it, rates are a little bit different. So you just want to have it in a high interest account for whatever reason. It would not be considered a withdrawal because you're keeping the money. Think your TFSA as the umbrella. The GIC, the high interest savings investment component, is underneath that umbrella. So as long as you don't kind of collapse that umbrella or move it, take it out from one umbrella and put it into another under another umbrella, there's not. So there could be a withdrawal if you're actually you're drawing it out of the GIC and out of that umbrella and then putting it under another umbrella that's also called the TFSA. That would be. But if it's within the same account, then there's no taxable withdrawal. Yeah,
there's two situations I can think of where it would not be considered a withdrawal. One is what you just mentioned, whereas it's under the same account number. It just went from one product to another product in that account number. So from a GIC to a money market fund or something like that. The other one is if you do what's called, or at least on the RSP side, it's called a direct transfer. I think they use the same words on the TFSA side, which means that I'm filling out a form to say, please move X amount of money from my TFSA at CIBC to my TFSA at RBC. That's called a direct transfer, meaning that it doesn't trigger my contribution limits or anything like that. I am just picking up an apple from one shelf and moving it over to the other shelf. And as LA Woman 4447 says, possibly, and that's what we're kind of touching on, is it depends on how the money comes out, what you're doing. So just speak with your financial institution and say, this is what I want to do. And I'm not withdrawing this. I don't need it in my hands. I just want to change the characteristic of how I'm investing this. Please tell me how to do this without affecting my TFSA contribution room that year. Please tell me how to do it without it being a withdrawal coming out of the account, if that makes sense. Yeah. Okay. Federal LIRAs, locked-in retirement accounts, and converting rules. Always money in the banana stand. Oh my gosh, Adam, do you get that reference?
What a handle.
Oh, okay. Adam, I have a Netflix series that you'll have to watch. Always money in the banana. There's always money in the banana stand. Just don't burn it down.
Yeah, just don't burn it down. Yeah. Why not burn it down? There was money in the walls.
Okay, all right. So you do get the reference.
Yeah.
Good.
I get that. Yeah, no.
You are cooler than I thought. Okay, good stuff. I have a question for consideration for your next week episode. It asks something that I haven't seen covered yet. I have a federally regulated LIRA. I'm 55 plus, retired and qualified for the financial hardship option. From the rules, I understand that I can unlock a portion of the LIRA according to the calculations on their website. Next, I understand that I have to convert the federal LIRA to a LRIF, not a LIF, but a locked-in retirement income fund, LRIF. Upon this move, I understand that I can unlock 50% to move into an RRSP, as this option is available to federal LIRA to LRIF. Have I got this correct and in the correct order? Because my LIRA is federal, I cannot convert to an LIF, LIF. It has to be an LLIF, RLIF, RLIF. And so I'm going to kind of stop there, and then we'll get to the last sentence there. I'm going to answer this by kind of following it through my own kind of thought process here. First and foremost, if you qualify for the financial hardship option, you should, I believe, and every jurisdiction is different, I believe you should be able to take money out of the LIRA directly. Most financial hardship options I've seen, that you can just take them from the LIRA. Yes, there is a calculation on how much you can take out and under what reasons and all that kind of stuff. And it will be taxable. It will be taxable income. So I would first and foremost check that if you need money out of that account for financial hardship reasons, that I'd be looking at taking it directly from the LIRA, especially if you don't need to be moving it into a LIF of whatever type, an LRIF or not. Yes, the LRIF thing, to my mind, is just a different name. So federally, and I think Saskatchewan uses the LRIF nomenclature, whereas other jurisdictions use LIF. I'm sure there is some small difference. This is where I'm going to have to plead ignorance. I'm sure there is some small difference, but for the most part, I believe, other than the jurisdiction differences, they pretty much act the same. And yes, in order to unlock 50%, almost always that money, almost always that money has to go into a LIF/LRIF first, and then the 50% comes out. Not always, though, but I'll leave that to dive in deeper some other time. So in the most part, I do believe you have it correct, other than the fact that the financial hardship option, I believe, can come straight from the LIRA without having to do anything with the LIRA. Adam?
Yeah, no, spot on. Always money in the banana stand always. Yeah, right on. There's an RLIF and an LRIF, which, typical, make everything confusing. So an RLIF, a restricted life income fund, is available for individuals with federally regulated locked-in. So in this case, that's it. An LRIF, a locked-in retirement income fund, primarily available for pension funds regulated by the provinces of Newfoundland and Labrador. LRIFs were previously available in other provinces. Those provinces have since phased them out. So typically, an RLIF is most common. Like when we see federal LIFs, they go to an RLIF, a restricted life income fund. But again, there is that unlocking of 50%, like was mentioned in the comment.
Yeah. And finally, the next pain point is that Wealthsimple. Sorry.
Yeah, no, go for it.
Okay. Is that Wealthsimple, and they do not offer federal RLIF accounts. So I need to find a new institution. So first I would check that. It's very possible they don't. I don't know Wealthsimple to that degree.
I think they do. Because we were on their advisor platform years ago, I'm quite certain they have it. I would be shocked if they didn't. No. Yeah. I'd go back.
If you do have to move around, open suggestions for a new institution, you'd have to just check the other institutions that are out there. I don't know them well enough to say this one is better or worse than the other. Yeah.
Wealthsimple has their own custodian, and I'm quite certain they've solved that problem with the RLIF and LRIFs many years ago. So, next question: transferring LIRAs out of financial institutions into brokerage. So this comes from Spasi Koki. I'll pronounce it that way. Have a DC pension with work. For reasons I don't want to get into, a small part of it is federal, and the majority of it is provincial, Alberta. The pension is currently with one of the large/expensive financial institutions, Manulife, Sun Life, etc. I plan to stop working soon and convert the provincial portion to a LIF, unlock and transfer 50% to RSP. But I do not want to keep it with the current expensive financial institution. At what step do I transfer the LIRA LIF to my preferred brokerage? So as far as the expensive part, a lot of times group plans are actually quite cheap. It depends how big your group plan, how much assets, all that. But a lot of times, Manulife, Sun Life, 2 examples put in here. Yeah, you might be paying under 1%. The problem is once you retire, all of these institutions, as far as I'm aware of, IA is the only company that keeps the same pricing. So when you retire or when you leave a company, your fees don't go up. They actually stay the same. So again, confirm that with your advisor that works on your group plan. But yeah, typically Manulife, Sun Life, the fees go up. So it can get quote unquote expensive. At what step do I transfer it out of, say, I'll choose Manulife in this example. So when you retire, when you leave work, you will get a package on what you want to do with it. At that point is when you typically want to transfer it out. You could transfer it into, a LIRA and RSP and do all that prior to, but then you're just transferring out more accounts. It's easier to kind of transfer it out and then deal with it all at the new financial institution.
Yeah. So when you have a defined contribution pension plan, I'm sure there's an edge case, but I've never seen a case where you can transfer it out while you're a member of that plan. It has to. You have to end being a member and it becomes a locked-in retirement account. Then you can transfer it out. The comment about expensive financial institutions, I've touched on this in other podcasts in different ways. Again, I don't believe that the institution necessarily dictates that it's expensive or not expensive. It's the advisor that you're working with. Again, I'm not laying that at the advisor's feet. I am laying it at the financial institution's feet to hopefully train your advisors better, or at least giving them the option. But they, for the most part, they have access to a wide range of things. Yeah. I think that's all I've got to say about that, Adam. Everything else, bang on. Okay, final one. Yes, final one. Triggering penalties in TFSA. I apologize. I'm going to kill this one. Yokobu Tenshi. My apologies if I've messed that up.
Japanese. I assume Japanese.
Yes. Yeah. Yeah, I've been told by an accountant who doesn't specialize in taxes, I'll get to that point in a moment, that even if you don't excessively trade, a large gain will trigger a penalty regardless. I've made a single trade, one sell, then purchase this year. That single trade doubled my account value. Will that trigger a penalty if I sell the stock this year? So I'll just take this in order. I've been told by an accountant who doesn't specialize in taxes. That may seem like doesn't compute. Not all accountants or how we use the word accountants, bookkeepers and things like that. So, but I would be talking with an accountant that does know this stuff. Quite frankly,
it could be a CMA, like CMA, CA, yep. CPL kind of merge that CA. It could be a CMA that doesn't have that background, but yeah.
Yeah. It's like using the word doctor, right? Not every doctor is going to know what to do about my knee versus another doctor knows what to do about my shoulder, for example. Then if you don't excessively trade, a large gain will trigger a penalty regardless. Not too sure. I'm going to guess on what you're talking about in terms of the penalty. But in terms of capital gains are only triggered if there is a disposition, either actual or deemed disposition. So you've sold something or you were deemed to have sold something. So you're saying if you don't excessively trade, I don't think it matters if you excessively trade or not. If I have one investment in a non-registered account and I haven't traded for years and years and years, and then I sell part or all of that investment and it has a huge capital gain, I haven't excessively traded. But when I sell, it's like selling a second property. I am going to get a capital gain on that. And so when you do dispose of that, either actual or deemed disposition, that will be a capital gain. and a percentage of that will be added to your taxes. So when you say that that single trade doubled my account value, will that trigger a penalty if I sell the stock this year? Kind of two answers to that. One is the trade that you already did, the sell, then the purchase, the sell that you already did may add to your taxes, depends on what the characteristics of it. And if you sell the stock that you purchased this year, again, it may add to your taxable income depending on if there was any growth there. So some unknowns there, but I think I've kind of parsed it out. Adam, anything on your side?
My guess here is that they're talking about TFSA, and that's based on the question comes from 5 things you never do with your TFSA. So,
okay,
they might be jumping, but I think that's a good point as far as like the non-reg account that you talked about. But yeah, if they're talking about TFSA, which is my guess here, they are. Yeah, if you don't, we've talked about excessively trading, what that looks like. There's no guidelines from CRA. If you have a large gain off of one, if you bought NVIDIA 3 years ago in your TFSA for 15 grand, it's worth $195,000 today, 3 years later. If you sell NVIDIA, yeah, you weren't trading that account. It's a good investment. Yeah, of course you're not going to be penalized. So, will that stock trigger a penalty if I sell the stock? No. If you have literally 3 years ago today, NVIDIA was $15. It's now, around $195. If that's in tax-free, no, of course, that's going to be tax-free. There will not be a penalty on that. You're not excessively trading. You're buying, a common share essentially. So yeah, no, I wouldn't be worried about that. I think where CRA is really trying to crack down is people that are buying and selling on a daily basis. Like there's an active trade every day within a TFSA account. I think that's where you run into some trouble. But no, I mean, if you hit a home run on NVIDIA or whatever stock or investment you have, and it's done well for a few years and you sell it, perfect. Good on you. Yeah. And we've seen it. Yeah. We've had clients come in with $1 million TFSAs, many with $300,000, $400,000, $500,000 TFSAs. Of course, they've done well on their investments. So, I think that's the intention of the account at the end of the day.
Yep. I'm going to blame the cold that I have on not connecting the TFSA and the excessive trading.
Yeah. Well, I didn't stop you because you're making good points about a non-registered account, which I think a lot of people have questions on as well, right? So, yeah.
So you didn't stop me because you didn't want me to look like a fool or anything like that. You didn't stop me because you thought I was making really good comments. That's my takeaway.
It's just you're adding to the question. Exactly. Yeah. Exactly.
Thanks, Adam. I appreciate it.
Yeah. No problem. No problem. What we saw this week, going to bring Kyle Martins, who's one of our financial planners partners at the firm here, in to share a little bit of insight from a client case you saw this past week. So yeah, Kyle, thanks for joining us. Maybe share what you saw this week.
Awesome. Well, thanks for having me on the podcast. I guess one thing I can bring up this week is I met with a client and we were able to hit their goals easily. So one of the things that we talked about is she really just enjoyed her work and she didn't really want to give up that part of her life yet. And so we had the conversation where she doesn't really need it for income. So we talked about, hey, do we look at transitioning into almost this semi-retirement? And the more I talk to clients, the more that this kind of comes up is, I don't want to fully detach from my workforce just because I enjoy what I do, but maybe I'm going to work at 50% capacity, 25% of capacity, whatever the case may be. And so we kind of went through that conversation. Again, you talk about on the podcast, a lot of retirement is psychological, 95% psychological, and then there's a little bit that's financial. And this is really where that conversation happens. And so it's important to kind of look at the plan and say, well, you don't need this money, but what is your priorities moving forward? And maybe that's a part-time position or reduced workload.
Yeah. And people can also see, like, if I do work a little bit, like, what's that worth? Like, what's the benefit? And sometimes it's a financial benefit. Sometimes, yeah, it's that more psychological, right? We always say you want to retire to something. And if you don't have that full to something to retire to, maybe that ease in to retirement. And it could also be an ease in because maybe your spouse is just retired and you don't want to full out retire at the same time. And it's that slower transition too. So something we see quite often. And so people that are coming up to retirement, and Kyle, that are thinking about this, like, what's maybe a good step for them to look at to kind of ease in? Should they be running some scenarios with their planner of doing part-time, or what would you recommend there?
Yeah, first of all, I'd recommend, like, okay, worst case, if you were to fully retire, like, does the numbers work? And if the numbers do work, then it's like, okay, now you don't have to work if you don't want to. But if you do want to, then yes, you should have that kind of built into the plan, whether it's 50% of what you make or 25, whatever it is, because that will affect the overall tax plan. So there are some considerations there, but yeah, run the scenarios, make sure you talk to your planner, like understand like what's the pros and cons of doing so, and then really just figure out what are your priorities. Like if you enjoy work that much, then great, let's kind of structure your plan around it. And if you want to just cut loose and not work at all, then you have the ability to do so at any point in time.
Yeah. And we've seen a lot of people, it's, I want to retire, but I know I can't, but can I work part-time or 75 or 25%? And, again, running that financial plan just allows you to kind of open that door of like, okay, I could move to 50% and financial be okay and be able to retire in 2 years, which is my goal. And so you can kind of start scaling back. So yeah, definitely something good to run that a lot of people actually miss out on. So yeah, sit down with your financial planner, run some, what if scenarios. What if I go back half-time, part-time, whatever it is. So yeah, no, great insight there, Kyle. And thanks for joining us in this episode, and we'll get you back on here soon.
Awesome. Thank you so much.
And jumping into tip of the week, Brett, let you take this over here.
Yeah, so I saw it in an article on advisor.ca. Mainly, it's industry focused, not necessarily customer focused, consumer focused. But I still think there's some great information there, and it talks about a TD survey that was done recently, about 1,500 participants. 2/5 of Canadians with TFSAs are sitting on cash. That's the title. However, I think the underlying title, the subtitle, a TD survey found that 39% of Canadians are holding cash because they didn't necessarily know how to use the TFSA. Now, this is mainly a survey that was done of Gen Z and millennials, or at least they found. I don't think it was a survey done of just them, but they found that cohort were more likely to keep cash in their TFSAs because they didn't know what a TFSA might be for and what they should be doing for it. So regardless of the age group, I think this cuts across everybody in that I think we've touched on it before. Unfortunately, it's probably not the best named account in terms of tax-free savings account. So we get that idea. It's a savings account. It's a high interest savings account. It's an account. It's an account under which you can hold virtually, not 100% accurate, this comment, but virtually the same investments that you can hold in an RSP, locked-in account, RIF, non-registered, the whole gamut. Virtually, you can hold the same investments. So a TFSA benefits mainly from the tax-free growth. So we don't get a tax deduction by putting the money in it, but the money grows tax-free. So in general, everything else being equal, I am going to be hopefully touching my TFSA last, and I'm going to let that money grow as much as possible. So there can be some argument that I'm going to put my highest growth money or my highest growth investments, into a TFSA. That's a discussion for another time. But the idea would be that cash would not be helping me as much because, yes, I'm not getting taxed on any interest income or whatever of that cash, but I could also not be getting taxed on incredible growth from investments in that. So my takeaway from this is that when you're using your TFSA, there's nothing wrong with holding cash in it. But if you do have the opportunity to have some of that for longer term investment that you're not going to be touching for some time, you may want to be considering changing some of that cash, but that would have to go with the advice of a planner or an advisor.
Yeah, you should only have cash in your TFSA if you have that need for it in the next 3 years or so. Outside of that, get it working for you. It's a tax-free investing account where a lot of people use it as a tax-free savings account, saving for cash, GICs. A lot of people use it as a tax-free checking account where it's like money in, money out, dealing with like that. That's not the intention of the account. If you learn, if you're not sure how to use your TFSA, just do your research, watch videos, read stuff, figure out how it works. It's a very, very powerful tool. The fact that you open one is a good step. Now learn how to actually take advantage of the tax benefits of that account because it's massively important. So yeah, do some digging, but definitely, unless you need money short term, and for younger people, it could be your first home savings account is topped up. You're using TFSA. This is money for a home in the next few years. Yeah, maybe cash makes sense. You're getting 2-3%. You're not really saving a lot, but it is what it is. But definitely fast forward if you're saving for retirement, that kind of stuff. yeah, you get that money working for you tax-free. It's a huge benefit. So
Absolutely.
yeah. Perfect. Well, that is episode 13. Thank you, Brett. Appreciate your time. And
No problem.
yeah, again, if you have any follow-up questions, feedback, comments for us, leave those below whatever medium platform you're watching or listening on. Thanks for joining us. We'll see you next week.
Absolutely.
Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.